What if your money kept growing even when you were sleeping? What if instead of working your entire life for money, your money slowly started working for you? Sounds powerful, right? But here's the truth. Most people never experience this. Not because they don't earn enough, but because they never learn how to invest. They keep saving money, but they don't grow it. And slowly, without even realizing it, their money loses value. So in this video, I'm going to show you simple, practical investment ideas that anyone can start. Even if you're a complete beginner, and even if you don't have a lot of money, no complicated terms, no confusing strategies, just real knowledge, explained in a way that actually makes sense. Let's begin. Why saving alone is not enough. Most people believe this. If I save money, I'll be financially safe. And yes, saving is important, but saving alone is not enough. Because saving protects your money, it does not grow it. Now think about this. Every year, life becomes more expensive. Food prices go up, rent increases, and even basic things start costing more. This is called inflation. And inflation slowly reduces the value of your money. So even if your money is safe, it is quietly losing its power. Let's say you saved $1,000 today. After 5 years, that same $1,000 won't buy the same things. So what's the solution? Investing. Investing helps your money grow. It allows your money to beat inflation, and over time, it builds real wealth. The power of starting early. Let me explain this with a simple story. There are two friends, Alex and Ryan. Alex starts investing at the age of 20. Not a big amount. Just a small investment every month. Ryan waits. He thinks, I'll start later, when I earn more. So he starts at 30. Now here's the interesting part. Even though Ryan invests more money later, Alex still ends up with more wealth. Why? Because Alex had something Ryan didn't. Time. Time allows something powerful to happen, and that is compounding. Compounding means your money earns returns, and those returns start earning more returns. It's like a snowball. Small in the beginning, but as it rolls, it keeps getting bigger. So the earlier you start, the easier your journey becomes. Don't wait for the perfect time. Start now, even if it's small. Mutual funds. If you're just starting, mutual funds are one of the easiest options. You don't need to pick stocks, you don't need to analyze companies, and you don't need to check the market every day. Your money is managed by professionals, and they invest it in multiple companies. This spreads your risk. Now let's talk about something very powerful, SIP or Systematic Investment Plan. In SIP, you invest a fixed amount every month. It could be $10, $20, or even $50. The amount doesn't matter, consistency does. When you invest regularly, you don't have to worry about market timing. Sometimes prices are high, sometimes they are low, but over time, everything balances out. This is called disciplined investing, and this is how wealth is built, slowly but surely. Index funds. If you want something even simpler, look at index funds. Index funds follow the market. They don't try to beat it, they simply match it. Instead of choosing one company, you invest in the top companies together. This gives you stability, because you are not depending on one company, but on the overall market. And historically, markets grow over time. That's why many experienced investors prefer index funds. They are low cost, low effort, and reliable. You don't need to be an expert. You just need patience. Stocks. Now let's talk about stocks. This is where many people get excited, because stocks can give high returns. But they also come with risk. When you buy a stock, you are buying a part of a company. If the company grows, your money grows. If it fails, you lose money. So what should beginners do? Start small. Don't rush. Learn first and understand how businesses work. And most importantly, never invest all your money in stocks. Use stocks as a part of your portfolio, not the entire portfolio. Safe options. Not everyone is comfortable with risk, and that's completely okay. If you prefer stability, you can choose safer options like fixed deposits, government bonds, or savings schemes. These don't give very high returns, but they protect your money. They are useful for emergency funds, short-term goals, and peace of mind. A smart investor always balances growth and safety. Here's a golden rule. Never put all your money in one place, because if that one investment fails, you lose everything. Instead, spread your money across different investments. Some in mutual funds, some in index funds, some in stocks, and some in safe options. This is called diversification, and it reduces risk while making your journey smoother. Most people don't fail because investing is hard. They fail because of simple mistakes, like trying to get rich quickly, following random advice, investing without understanding, or panicking when the market goes down. And the biggest mistake of all is not staying consistent. Remember, investing is not about luck. It's about discipline. This is what truly builds wealth. Consistency. Not big investments, not perfect timing, but consistency. Even if you invest a small amount every month, you are moving forward. And over time, compounding does its magic. The market will go up, and the market will go down. That's normal. But successful investors don't panic. They stay calm, stay invested, and think long-term. Because real growth happens over years, not days. Final conclusion. Let's keep it simple. You don't need a lot of money to start investing. You don't need to know everything. You just need the right mindset, a simple plan, and consistency. Start small, stay patient, avoid mistakes, and give your money time. Because wealth is not built overnight, it is built step by step. Final line. Don't wait to become rich to start investing. Start investing today and let your money build your future.